Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back for another weekly market recap featuring my good friend Lance Roberts. You're noticing I'm in a different atmosphere background yet again, and that's because of the atmospheric river that is dumping gargantuan amounts of rain in Northern California. I've been without power. Today is day 3, I think. It's been kind of, fun and novel, but that's really beginning to wear off at this time. Lance, how you doing?
I'm doing good. It kind of reminds me of, our Texas freeze a couple of years ago where we had 5 days without power, but it was 4 degrees in the house. So
yeah, I will say it's a big difference. Yeah, not having to worry about freezing to death in the middle of the night is pretty, I'll take that.
But yes, it sucks being without power and not being in your house. And, I'm sorry about that.
Hey, well, no worries. And hey, speaking of cold temperatures, you were away skiing for the holidays last week. I got to get a little dig in and tell you that not only did Michael do his usual great job here on the program, your colleague, Mike Leibowitz, but it was the #2 performing weekly market recap in terms of views ever. So he is like fast on your heels, buddy. But anyways, you were out in Utah skiing, and you guys got more than your fair share of snow, right?
Yeah. No, we had a blizzard. We were basically stuck in the house for an entire day. It was like -2 degrees, and you couldn't even see outside. It was snowing so hard. But that's just part and parcel of the weather we've got going on right now. So.
Okay, well, look, glad you're back. Glad I don't see any, leg casts or anything like that. So I'm glad you skied safely.
Yeah.
Look, a lot to cover in today's recap. Nothing new about that, but we'll do our best to get through it as quickly as possible. Real quick before we do, I just want to make one quick announcement. I have been having an intern very kindly reached out to me, a young woman who knows more about sort of the new social media platforms than a dinosaur like myself. I'm pretty good on YouTube and Twitter. She is really good on Instagram and has created an Instagram channel for Wealthion that she's been running for the past couple of months. It's now actually beginning to get to critical mass. It's actually beginning to take off a bit. And she asked me if I wouldn't just let everybody know on today's video who is an Instagram user to go check us out there. The URL for that new Instagram channel is @WealthionOfficial over at Instagram. So if you use Instagram, want to follow us between the videos that we pump out here on YouTube, go follow us there. All right. Well, with that being said, Lance, let's talk about the markets. First week of the year, not too much market activity yet in the new year, but I was looking at the tape, and it seems that sort of since mid-December, the S&P has been punctuated by these spurts where it just seems to try to take off and then it comes back down again, tries to take off, comes back down again. We've seen 2 of those again this week. What do you take from this activity, and what are the odds, do you think, one of these might actually end up igniting some sort of rally here at some point?
Well, we got it on Friday. I mean, if you go back and look at the tape over the last really 3 weeks in this whole Santa Claus rally, the market really was in a very defined trading range for really 3 weeks. I mean, we go up 0.5%, down 0.5%, really just went nowhere. On Friday, because of the employment report coming in, and again, jobs stronger than expected, but wages came in weaker than expected. Market was up almost 2.5% on Friday. So that broke us out of that consolidation range to the upside. And we've been talking about in our newsletter, as well as our daily commentary over the last couple of weeks, that if we broke out to the upside, that'd take us to about 3,900 on the S&P, which there's a convergence of moving averages right at that point. The 200-day, the 20-day, the 100-day, and the 50-day moving average all converge right at 3,900. So a lot of resistance right there. That's basically where markets stalled out on Friday. So again, broke out the consolidation range. Our MACD signals triggered a buy signal. Our money flow indicator triggered a buy signal. So that all suggests we will very likely see at least a short-term rally. Now, importantly, there is a downtrend line that goes from the highs of last year, which was back in January, and runs right along the 200-day moving average. Now, we've now established a higher low than we had back in October. So what we have now is this wedge that is developing in the market in terms of price action. So if we can break above 4,000 on the S&P, which would get us above that 200-day moving average, that may very well lead to a fairly strong rally, 4,300 into the middle of this year. So again, remember, we're in the seasonally strong period of the year, and we'll kind of keep a watch on things, but there is a bit of a bullish setup here for equity short term, and I'd be banking on the most hated stocks rallying the most.
Okay, so when we talked last week or last time you were on the channel, we kind of reviewed the outlook for 2023.
Yeah.
And I mentioned that, I mentioned what Felix Zulauf thought and a few others like him, and it seemed like you were in that camp where the general expectation is that equities probably weren't going to do so hot through the first half of the year. Is what's driving what you just described just sort of purely technicals?
Yeah.
Like, is it just, yeah.
No, it's pretty, look, I mean, the bottom line is that if you take a look at the fundamental side of the equation, right, the Fed is not, the Fed just came out with the FOMC minutes on Wednesday and basically said, look, we're going to keep hiking rates. We're not going to stop hiking rates anytime soon. We're still tightening our balance sheet. Quantitative tightening is still in process. So none of the fundamental side of the equation has changed, but markets were very oversold. Sentiment was extremely negative, and that brings up these opportunities where we have these fairly strong counter trend rallies of the market, which is where the Fed will come in eventually at some point and slap it all back down again. Because, as even Jerome Powell said, if you read the FOMC minutes, and this is in our newsletter this weekend, the minutes, they even lay out specifically in those minutes that market rallies ease financial conditions, which is exactly the opposite of what they want, right? So that's why every time we have these big kind of bear market rallies, the Federal Reserve steps in, slaps it back down again, tells all the bulls to get back into their corner. But again, it doesn't mean you can't have fairly significant rallies to trade into and certainly take advantage of it while it lasts.
Yeah, I was interviewing John Rubino earlier this week, and I didn't actually go and vet this claim, but he made the claim that despite all the rate hikes that the Fed has made since last March or whenever it was, that the financial conditions are easier today than they were when the Fed started tightening. True. Okay. Yeah, which is crazy, right? I mean, the Fed has been trying to say, look, everybody, we got to tighten the system. We got to get things under control. And the market has said, I don't believe you're going to see this through, Fed. And the Fed has been fighting this monster it created over the past decade.
Well, and the market is, yeah, absolutely. And that's the interesting thing, right? So the whole mantra for the last 10 years was don't fight the Fed. Now it's fight the Fed every day.
Well, that's what's so crazy. Yeah, exactly.
So, the market is exactly what, but the important thing here is again, the market rally eases financial conditions because it makes people feel better, right? So when markets go up, people feel better financially, so they'll go out and spend money. What the Fed wants is a controlled burn of the markets, and they want markets to come down. They want asset prices to come down. They don't want them to crash, but they want them to come down. They want this kind of controlled burn situation in the markets. And that's why they keep coming out. They let the market rally, they come out, slap it down. And that way, you've got, you rally 15, 20% like we did back in June and July, back like we did in November. You let the market rally 10, 15%, and then when you slap it down, it has to decline, but you're not setting new lows, right? You're just kind of getting back down to the previous lows. And if you actually look at a chart of the market from last year, since June, the markets have gone nowhere. We've just been trading sideways in a big range, and over that whole 6-month period, and that's because the Fed's trying to work off a lot of this exuberance in the market, but there's this fear of missing out, right? We talked about FOMO in 2020, which was the fear of missing out. We had all the stimulus, markets are going up. It's like, oh, you're an idiot if you're not buying the crappiest stocks on the planet because they're going up gangbusters. So there's this fear of missing out. Now there's the fear of missing out on the bottom of the market. So nobody's willing to get out of the market. ETFs, passive indexes last year had the highest level of inflows since 2008. So, investors are still piling money into ETFs, and that's exactly the opposite of what you would expect. If this was a bear market, and again, we've laid out, we haven't violated the 200-week moving average. The bullish trend is still intact from 2009. This is a correction. It's not a bear market. And it's also not a bear market psychologically, because in a bear market, nobody wants to buy stocks. They wouldn't be piling money into ETFs if this was a bear market.
So it's so interesting, because one thing that will kill this just really stubborn enthusiasm that the markets continue to have with this stubborn FOMO is what St. Louis Fed President James Bullard just said the other day, that you wrote a piece on, which I want to get to in a minute. A few more things to talk about before that. But he talked about raising the federal funds rate up to 7%. And if the Fed is able to engineer that, they will definitely succeed in crushing it. I know you're shaking your head saying it's never going to happen, but they definitely have the power to do it. The question is, will they have the backbone to do it? And we're going to find that out.
Well, look, real quick, Neil Kashkari just came out last week and said the Fed's going to have to hike rates to 5%. So there are Fed members that are pushing this idea of higher rates. And again, the whole point of hiking rates is, again, why do we hike rates? To slow the economy. And real quick here, we talked about this before, and I don't think a lot of people have figured this out just yet. When I hike rates, it takes about 9 to 12 months for a rate hike to show up in the economy. That's, higher credit card rates and all those type of things. Yep. So let's just roll back the tape here for a second. March of 2022 was the first rate hike. We did 25 basis points. So if that was the first rate hike, it's just now showing up.
Right.
It means that the 50 basis points that came after that, not in the economy. The 475 basis point rate hikes, not in the economy. The last 50 basis point rate hike, not in the economy. None of those rate hikes have shown up yet in the economy. That's still all coming. And you have no stimulus, and you got the Fed, reducing their balance sheet. So, the bearish case is really easy to make.
Yeah, and this is why I'm so stalwart about the probability of a serious recession in 2023.
But that's the problem.
Because so many people feel the way I do. Yeah,
exactly. That's the whole problem. And so as an investor, you have to start asking yourself, has that all been priced into the market? Now, I would suspect not all of it, but a good chunk of that has already been priced into the market. And the question really is how deep is that recession going to be? And that's the answer we don't know, right? And we don't know if the Fed actually winds up breaking something financially. That's the other big kind of outlier. But those are things we just don't know, and we won't know until we actually get there. But one of the big concerns, from a money management standpoint is how much of this psychology has already been in. Because again, everybody you interview, they're all like, oh, the world's going to end and the recession's coming, and it's an absolute guarantee. When this will be the most forecasted recession ever in the prediction of environments, then the market has already priced that recession in if everybody believes that's the case. See, that's the problem. That's the risk.
That is the risk, and certainly could be the case. And again, Lance, that's why we have you on here every week to be tracking all this for us. But as you've said, still tons of inflows going into ETFs. People are still long. Despite whatever the bearishment sentiment might be out there, they are not acting the way that they are talking. Right?
Exactly. That's it. And look, I agree. By the way, I just don't want anybody to think that Lance is in this bubble over here thinking there's going to be no recession. I'm not saying that at all. I agree with you. I don't see. We said this, before. I don't see how we avoid a recession. Right? You take a look at what's happening economically, the ISMs, all that. How you avoid a recession, I have no idea. But is it possible? Sure. We've got to, we got to give some credence to that. But this is going to be a weird year. That's all I can tell you.
Yeah, I think so too. And you're performing the function you should on this channel, right? Which is to say, look, it's all about probabilities, right? And there are very few 100% probabilities in the world, and therefore you have to be open to the other non-zero ones, right? So I totally agree, and I want to encourage you to keep doing that going forward. I do just want to say, that said, sometimes when you see the runaway tractor trailer that is headed towards the crowd and everybody can see it coming, it doesn't stop the trailer because everybody sees it coming, right?
I don't disagree. But let me give you another good example of what I'm talking about. So, we've talked before here about, I sold my house, back in July.
Yep.
And It's amazing. I mean, my wife and I are looking for a new home to buy, and we're not in any rush. We're waiting for prices to come down like everybody else. Nick Gurley, everybody else talk about the housing crash is here. Let me tell you something. In Houston, prices aren't going down, and houses are sitting on the market for a few days, then they're gone. So it's interesting from the standpoint that we see this kind of national data. But once you start getting into pocket, and this is all anecdotal to me, right? The specific size of house we're looking for happens to be kind of in a mid-tier sector, I'll get that spit out, a mid-tier category where there's a lot of demand, right? Now if you get into the big, 6,000 square foot houses, those type of stuff, those are definitely sitting on the market longer. But once you get into 2,500, 3,000 square foot homes, they're still moving very quickly. So, you kind of look around and go, well, where's this recession that's coming? I thought prices were supposed to come down. Maybe that happens this year. But it's interesting. It doesn't seem that, and again, going back to what we said, these interest rates are going up, but it doesn't seem to be deterring people. And I don't know if that's a function of just, there's still a lot of stimulus money in the market that hasn't come out yet or what it is, but it is interesting that things seem to be holding up better than you would expect.
Right. Well, as we like to say, it is multifactorial, right? So we always want to know what's the one data point to watch to know what's going to happen. And the answer is it's usually a basket of them, right? And there is from the chart that I showed weeks ago that showed that there was still enough stimulus pig left in the python, back in Q4 that it looked like it wasn't going to be exhausted until about mid-year of 2023. So some of that still is sloshing around, but also this is a process. Like you and I talk about how, with job losses, right? Layoffs. Companies don't go straight to layoffs, right? They do the hiring freeze. They then cut benefits, cut hours, and then only then do they do layoffs. It is similar in the housing market too, right? Where, as you said, sort of the high end goes first, but now you're competing not just with people at your level, you're competing with people that are downshifting their lifestyle from the high end, right? So it actually supports demand in the middle zone for a while, right?
Yeah, it does. And look, and to be fair, I've got an article I'm writing that'll come out in the next week or so. I did a whole bunch of work on housing prices, and because I'm very interested in it right now because
right, you personally motivated,
right? But the data, and look, I agree with Nick Gurley because the data clearly shows that home prices have to come down. Supply is rising very sharply here. The ability to finance stuff is really becoming much more problematic. So, all the evidence, again, this is the recession story again, right? All the evidence is there of a bigger price decline in housing. All the evidence is there of a recession, and it's just, from an asset management standpoint, the question is, does it happen the way we think it does, or is it something entirely different? And it could be either side of the equation. It could be really, really bad, or we have no recession or depression, but I doubt it's going to be a soft landing.
Well, so it's funny you say that. So I have this earmarked for us to talk about later, but maybe we'll just quickly talk about it now. So I was talking to one of my really good friends, Charles Hugh Smith, who I believe you know, Lance, right?
Absolutely.
Yeah, great writer, great guy, and he was. This was not his idea. I can't remember whose idea it was, but he was commenting on it. He just said this was such a great question. He said, "What if the black swan is the Fed actually landing the plane?"
Yeah,
right. Because
for the first time ever,
right? Because when you think about it, that is the one thing that nobody believes is going to happen.
Exactly.
Right.
No, exactly. Oh, look, after you crashed the economy 9 times in a row, maybe you get it right once, right? I mean,
yeah. And, I don't think anybody on the bullish or bearish side really thinks the Fed can engineer exactly the type of soft landing it looks for. And like I said, so nobody's putting any probability on that. But if that were to happen, that would blow up a lot of people's expectations, right?
Yeah. There's one thing about that, we've talked about before that inflation will cure itself over time, right? High prices is a cure for high prices. I think the Fed, I think there was a shot for the Fed to actually have a soft landing. And if
like December of 2020, right?
Oh, no, I think maybe even before that, probably back in August, September, but I think probably once you got up to about 3.5% on interest rates, I would have paused there,
Right.
and let those filter through, and then kind of figured out where we were.
Right. And stop the QE.
Yeah. And so, they had a shot to probably engineer something. I think they've gone too far now. And this whole idea they're going to keep hiking rates until they see evidence of it. And you take a look at the employment numbers on Friday as a good example. Only 1,000 of those jobs were full time. The rest of them were all part time.
Yeah, and the 1,000 jobs were a loss. It was a negative 1,000.
Yeah, exactly. And so they're all in leisure and hospitality, retail sales, that type of thing, right? Which you would expect for the holidays. So what I think is going to happen is that a lot of this data is going to catch up very quickly with the Fed, because you take a look at ISM, S&P global indexes, et cetera, and they're all in contraction territory. So I think a lot of this catches up with the Fed extremely quickly, and then they're going to have to start backpedaling to try to save it. But if they would have, if they would have stopped a while back, let it filter through, reevaluate, I think they would have a better shot. They're so concerned about this entrenched inflation. And the reason we have inflation is because you shot $5 trillion worth of liquidity into the market and shut the economy down. Of course, you're going to have inflation. Now supply is coming back online, liquidity is leaving. You're going to have disinflation. That's just, and as you said, we wrote that article talking about the pig and the python. That pig is about to leave the python through the back end. And, I think you're going to wind up going, oh, crap, we went too far.
Okay. All right. So you just talked on two things I want to go through here. One is the jobs markets, the jobs data today. So let's quickly parse the jobs data just so folks who haven't read it know what's going on. And then I want to get to the actions that the Fed is taking, because my question to you, which I will re-ask when we get there, is the Fed pulling out the 1970s playbook right now mistakenly? Right. In other words, is it using a playbook that actually doesn't fit the reality on the ground here? And you've just written a piece called The 7% Solution that really sort of dives into this. So I want to dive into that with you. Real quick, let me just go through some of the stats here. So this was another quote unquote strong jobs report, payrolls report. But as you said, Lance, of the increases in the jobs is roughly 700,000 jobs created. Actually, full-time jobs decreased by 1,000, and part-time jobs increased by almost 700,000. I think it was 679,000. It was the second consecutive month of declining work hours. So interestingly, even though the number of jobs is increasing, the number of total hours worked is going down, and it's starting a trend. Mike Shedlock did a couple quick calculations on Twitter to show that I think it was something like 1/10 of an hour. It went down by 1/10 of an hour, which doesn't sound like a lot, but when you actually multiply that by the workforce, that is a massive amount of work hours that aren't being worked, right? Yeah. So a lot of large numbers. And wage growth is slowing. So wage growth is still increasing. It's at 4.6% now, but it is disinflating, just like CPI is. It's now the lowest since August of 2021, and still negative on a real basis. So I'm sorry you're seeing lights go on and off here, because we're still apparently in PG&E is still fiddling with the power lines and stuff like that in the town that I'm in.
Well, I can still see you, so it's fine.
Okay, good. As long as you can see and hear me, we're going to keep on going. So basically, this is one of those again, times where it sounds like we're being sold a story that doesn't really match with the reality that we're seeing in the world. I'm just going to put up a quick chart here, again, one that Mike Shedlock recently shared on his channel. It's from a household survey by demographic category, by age category. And it shows the percentage of people who regularly run out of money and have to rely on credit cards or family for financial support. You'll see that millennials, it's over half. Yeah. Right.
But you would expect that, though, right? And they're not in their peak earning years yet, so they're looking.
Well, but millennials are beginning to get. Their household formation, right? But anyways, but even for Gen X, right? For my generation, it's like 45%, right? So it's material, right? And it's apparently this is a snapshot, this chart, but I think the data series that's drawn from this is a worsening trend over time. And Lance, you've talked a lot about the, huge percentage of households that can't come up with $300 in an emergency, whatever it is, right? So last point I want to make on here, and then I'll let you run, Lance, is we've talked a lot about how the BLS calculates their establishment survey and how they conduct the household survey, and how we've been seeing this massive growing gap between the two. It got as high as 2.7 million job delta between the two. They are now adjusting that. You predicted they were going to see all these adjustments come in. But the data they released today show that 2.7 million job gap has now dropped to a 2.1 million job gap, which is still a pretty big delta, but we can think, okay, they're finally beginning to, admit that they were, calculating the numbers poorly. But instead of the establishment numbers, which are the ones that seem really hard to believe coming down, it was more the household survey numbers going up. And this contradicts, everything that we're seeing, Lance, right? You just mentioned, like the ISM data. I just looked at the recent Philly Fed data that, suggests that the jobs added in the first half of 2022 were not the millions that the BLS was suggesting, that it was more like 10,000, like only 10,000 jobs.
Oh, Philly Fed, yeah.
Yeah, Philly Fed. And then, we just heard, this week, more big layoffs. Amazon's laying off like 17,000 workers. Salesforce just announced that they're going to lay off 10% of their workforce. So my point is it still feels like we're sort of stuck in this Groundhog Day where we're being told how great the jobs market is, where when we dig underneath, it doesn't seem that good. But the Fed is still using this data to say, I got to keep tightening.
Yeah. No, there's a couple of things too. And I don't have any data on this just yet, but I got emailed from a friend of mine that I correspond a lot with. And he made the point that once a year, they make an adjustment to the household survey for immigration, right? And we have this, of course, this big immigration problem on the border, et cetera. And so part of that gap that exists between the BLS and the household survey has something to do. And again, I don't know this for a fact. I'm doing the research on it now to try to find this out. But apparently that has something to do with the fact that the immigration has not been factored into that number yet. And so part of that adjustment up in the household survey that closed that gap may have been accounting for some of this immigration coming in. So we'll find out. And then, because we're going to get a lot of revisions over the next 6 months, in June and July of this coming year, of 2023, you'll get the revisions to last year's employment data. And so we'll be able to, at that point, when they revise it, that's when all the dirt comes out. So we'll find out exactly, what these numbers look like. But look, it's hard to believe. And just to your point, you have layoffs going on, you've got slowing economic environment. I talk to small businesses constantly. They're not hiring people. And yet I just saw data out today that small businesses are hiring like crazy. And none of the people I do business with and none of the small business owner I know, nobody's hiring right now, other than, restaurants hiring wait staff and that type of thing, right? So, I think you're in revision of that data just Wednesday or
Yeah. All right. So then building on this theme of the Fed, perhaps looking at data that is erroneous, or it's so far lagging that it's not matching, the world that we're living in today. Let's go into your piece on the 7% solution. So you've got guys like St. Louis Fed President James Bullard now saying, hey, we might not need to stop at 5. We may have to go up to 7% to slay this dragon, right? And my read of your piece was, yeah, they're behaving as if this is the 70s. Right. And the factors that created the inflation we had in the 70s are different factors than we have in terms of what's created the inflation now. And they needed to do what they did in the 70s to slay the dragon then. But in some ways, the dragon is kind of dying in front of us right now. And yet the Fed is still continuing to rally the armies to go after it, and may make a much deeper, more painful recession than is necessary as a result. So let me let you run on. You wrote the piece, so
Well, no. So look, you have to, the mistake I think the Fed's making is that they're looking, to your point, they're looking at the 70s and they're going, well, we're worried that there's going to be an entrenchment of inflation. And so like in this weekend's newsletter, I'm addressing that in particular, because that was a comment made by the FOMC, is they're afraid that inflation will do what it did in the 70s, which you had this run up in inflation, and then it started coming down, and then it took off again. And that's what the Fed is supposedly very fearful of. But we have to remember that this is not the 1970s, right? We have a very different economic environment today than we had in the 70s. So let's go back to the 70s for a moment, and I'll put our bell bottoms on and join Ashton Kutcher in the house. And so here we are, it's that 70s show. And, what did we have going on back then? Well, first of all, households had no debt to speak of other than the mortgage. So the debt to net worth in the 70s was about 60% of debt to household net worth. And that was vastly the mortgage. Maybe a small car. You got to remember, cars cost like $6,000 back then. So people didn't have big car notes. My dad, my parents, and most people I knew growing up, if you had a credit card, you were like the uber rich, right?
Right.
People did not have credit cards. You had a checkbook and you paid cash for most everything. And, and so it was a very different environment, but everybody, most everybody was involved in some type of manufacturing, blue collar type work. There wasn't a lot of the professional class. I mean, there were the managers of companies and those type of things, but a vast majority of workers were blue collar, middle class Americans making a good living, right? They did what they do. They were producing and they were manufacturing. Now remember, manufacturing has a multiplier effect in the economy of about $5 for every dollar's worth of manufacturing. That's because when you're manufacturing something, it requires a whole lot of other inputs, right? Commodities, et cetera. Today, back then, 80% manufacturing. Today, we're 80% services, which has no throughput, and there's actually a negative multiplier on services. So you had inflation back in the 70s. It was driven by higher wages. Wages were going up because people were producing. So let's talk about how an economy works real quick, just to get everybody on the same page. We're a consumption-based economy, right? 70%, if you take a look at GDP and the calculation of GDP, roughly 70%, it's a little bit less, like 68% of GDP is personal consumption expenditures. It's what you and I buy, and what we do, what we spend in the economy. We can't spend money unless, theoretically, we work for it, right? So first thing we've got to do, Adam's got to go to work, I got to go to work, we got to earn a paycheck, we produce something, we get paid, and then we go buy, right? And we spend money. So this is the virtuous cycle of the economy. I produce, I get a paycheck, I buy, that increases demand on businesses. As my wages go up, that increases demand, businesses produce more. As demand goes up, they've got to hire more people. As they hire more people, they've got to raise wages. Well, that gives me more money to spend, which I spend in the economy, creates more demand. That's the virtuous loop, right? So we get this great cycle. And guess what goes up and with that, right? So at the same time, we've got this growing economy in the 70s. Savings rates were about 8%. Economic growth was about 8%. We had a very strong economy. And wages were going up, which means inflation was going up, because why? As all this demand was happening, businesses were going, hey, guess what? I can charge more and they're still going to buy it. So inflation was going up. Interest rates were going up because banks were going, hey, there's so much demand in the economy, I can charge more for loans, and that's okay because businesses will borrow the money because they're making plenty of money. Everybody's happy. So the Fed decides at this point, now we have the oil embargo and inflation shoots up because of energy prices. I wager that the Fed made a mistake, and I wager that Paul Volcker made a mistake. And instead of aggressively trying to break inflation back in the late 70s, they should have raised interest rates somewhat to slow it down, but not go as far as they did, because ever since 1980, in the slaying of the inflation monster, what's happened? We've completely reversed the whole cycle. GDP has fallen almost annually. The growth rate we went from 8% growth to basically 2% growth now. Interest rates have done nothing but go lower. The Fed has continually had to lower interest rates and try to bail out economy one cycle after another. And inflation and interest rates and economic prosperity and everything else has declined. So when you go back and look at the 70s, it's a vastly different economic environment than we have today, where households have 150% of debt to net worth. They don't have $500 in the bank to meet an emergency. They don't have savings, in other words. And, the production level is going down. Productivity is declining, not increasing. And you take a look at, and wages have gone up here recently because of what happened in the Fed, but the trend of wages previous to this have been lower outside of this whole stimulus boost and shutting down the economy part. If that hadn't happened, wages would still be trending lower. So, the Fed's got an entirely different economy today, but they're trying to apply a solution that is an environment that we don't have anymore.
Okay, great. Yeah, and that was my main thesis here, right? Is, we are looking like we are going to experience the consequences, suffer the consequences, if you will, of, again, our central planners fighting essentially the wrong war, right? Mm-hmm. And I think we can say they've been doing that in a lot of different cases, but now the stakes are quite high given where things have gotten to at this stage. So it's just sort of my way of saying, all right, look, to your point, it's going to be a weird year, right? Like, we're really going to have to watch things clearly because it seems, from what we can tell, they're using the wrong playbook for the current battle that we're fighting here, and we're probably, you and I would say, we're going to have a much worse recession as a result. Now, you're saying because everybody believes that, maybe that's not going to unfold. Maybe it's going to be something totally different. So we're really going to have to keep our eyes peeled.
Yeah, but look, here's the big thing, though. I mean, just strip out all that other stuff and just get down to one factor: debt. Right? You're running 30 trillion in government debt, household debt, 150, 160% of debt. And you're going to raise interest rates in that. The only reason that people can afford the houses that they've been buying, and you take a look at the median price, the median price of houses, et cetera, median price of cars, median prices of crap that people buy. The only reason they've been able to afford it is because they could finance it cheap, right?
Well, not just cheap. These were the lowest interest rates we've had kind of in human history for a long time, right?
So if economic growth is predicated on 68% personal consumption expenditures, which is predicated on exceptionally low interest rates to support the increases in debt to buy that stuff, what happens when you're at 5% interest rates? This is
we're 7%.
We're 7, right?
I know you don't think we're going to get there, but he's saying they're going to try to get there.
Yeah, and so that's that. I mean, it just seems to me that the debt is going to be a problem. Sometime this year. I think it's just a question of when.
So totally agreed. And in your comparison with the 70s, one thing I don't think you listed in terms of what's different is not only was household debt much lower back then as a percentage of household income, but we were basically not, we're basically not running deficits on a relative basis to what we're doing now, right? So the national debt was tiny on a relative basis, right?
Yeah, we didn't really even have a deficit to speak of until Reagan.
The Reagan era. Yeah. So I mean, you could say, and I think we should say, is that we started charging everything to the national credit card starting with the Reaganomic era, and we've just every administration we've just taken that to a new excess, and we're now entering the part where the parents realize what you've been doing, they cut you off, the lenders don't want to give you any more, right? We have to start living with the debt hangover, and this is part of that, right?
Yeah.
Nobody wants to admit that, but I think that's part of what's in play right now.
Wait, before you jump off that, let me say one thing, because I do want to solve a little bit of a myth, I guess, because I'm getting a lot of emails from your viewers in particular about the national debt and like, oh my God, we're going to file for bankruptcy and the world's going to come to an end, blah, blah, blah. As long as we can print currency, we're not going to file for bankruptcy.
Right.
So,
now
that's not a good thing, right? I'm not saying that's a good thing that we can just print currency to the moon, but and we talked about this before, Adam. Look, managing money is about managing what we have in front of us right now that we can control, right? And there's certain opportunities where we can invest capital. And we've talked about before, trying to miss the end of the world scenario, you're going to lose a lot more money. And waiting for that to happen, because look, Japan's been doing this for 30 years. They're still going, right? So these things can. Will the U.S. at some point lose reserve currency status? At some point in the future, will debt become a problem? Absolutely. We may all be dead before we get there, but it's one of those things that you can't invest on that today on that premise, because that's not going to be anything in the foreseeable future that's going to be a problem.
Yeah. So Lance, I mean, I'll just give you, full carte blanche to when folks contact you about that, just direct them to the first interview I did on this channel with Brent Johnson, right? Who basically goes through exactly all that and says, look, he says, I'm not defending it. I'm not saying it's fair, but the US enjoys a ton of privileges, not only having its own printing press, but having the world's reserve currency and the military right now to back it up, that we can get away with a lot that we shouldn't be able to get away with. And we're going to be able to get away with it a lot longer than most folks can expect. And then when he talks about the dollar milkshake theory, yes, we have a lot of problems, but there's a lot of other countries out there that have way worse problems than us. Japan being a great example. Europe's now going into that same category. And because of the dynamics of the euro dollar market, highly likely, as the world experiences some of the hiccups you and I are talking about are likely to come, capital is going to flow into the U.S. and actually strengthen the dollar and strengthen U.S. Financial balance sheets. And so Brent's like, look, I'm not a fan of the dollar. I'm just telling you, if you're expecting it to die tomorrow, you're highly likely to be disappointed. So folks, if you've had that concern, maybe that fear that Lance was talking about, oh my God, how can you invest in the system because of all these things the US is doing? It's clearly going to die tomorrow. Go watch that video. I'll put up a link to it right here.
That's great. And look, and here's the thing too, just, this is not something where you're going to go to bed. So here, let me give you a great example of what I'm talking about. I'm standing at the airport waiting to board. So we got delayed 5 hours in Utah to get on an airplane. So I'm sitting there waiting to get to board. There's a gentleman behind me talking to his son, and he's telling his son all about Bitcoin and how Bitcoin is going to replace the reserve currency and so forth and so on. And it's all because, you can go back to the Weimar Republic and this is the cause of it. You can't take isolated incidents and pull them out of context. Weimar had inflation because they were losing a war and everybody had lost faith in that currency, right? So that's not the situation we have in the US. Yes, we're printing way too much money. Yes, we're spending way too much. And those are certainly, not good things. But to have hyperinflation, you have to have a complete loss in the faith of the currency. You're losing a war, or there's a complete repudiation of your debt. We don't have any of that right now. So, that's something though, if it would occur, right? And so here's my point. You're going to have plenty of time to see that coming. That's not something you're going to go to bed one night and then the next morning wake up in Weimar, Germany, right? You're going to see this coming months in advance because markets will be forecasting this to come. And so, my point is it's when you're investing capital into markets, and this is my job, this is all I do all day long, is look at what the markets are telling us right now. And because markets are good for about 3 months. And then outside of 3 months, don't invest on anything on some premise that in 5 years, this is going to be some outcome, because things are going to go 9 degrees away from zero before we get 5 years out. But, invest in what markets are doing right now. Look for those opportunities. In November of 21, we said, hey, buy energy stocks because they're so beaten up and so hated. They're going to be a great place to be next year. 2020, they were up 40%. Stocks were down 20%. So, the opportunities there is that you can, and then there's these thesis plays, which we talked about before. You can play a thesis, but don't bet your whole portfolio on it, because the odds are whatever thesis you think you have is not going to work. And you're going to wind up probably losing money over that time frame. Either the thesis will work, but it's too far out and you lost too much of the market return in the midterm to really make up the difference, or the thesis doesn't work out at all. And so, manage your money for what it is and manage your money for what the risks are. And all these things we talk about, these big macro things, are very interesting. And they're good things to know, right? And these are things that will have an eventual impact on the economy. I'm not saying that at all. I'm not saying that that's not a problem. Don't worry. I'm not in the MMT camp where, deficits don't matter. Not saying that at all. But what I am saying is that those things are such a long range out there that you can spend too much time wasting time and money trying to bet on some outcome to come that may not ever happen in your lifetime.
Right. And you might have already mentioned this in this discussion, but the famous Peter Lynch quote that more money was lost positioning for the next recession than was actually lost in the recession or market crash, whatever.
Yeah, exactly.
While you were out enjoying your ski trip, Michael and I actually talked a lot about this last week, and the importance, particularly, I think, in a year like we're likely to have coming ahead of us, of these weekly market recaps, because they give you guys as capital managers the ability to call audibles. Right. As things are changing, right? You start the year with a thesis, or you come into the year with a thesis. That thesis may be radically evolved by the end of the year. And it's probably not going to be because you wake up one morning and just change everything. You're going to see a progression of things happen, and you're going to start making zigs and zags in response to that. So, I'm giving you full license, Lance, as you come on week after week here to call as many audibles as you want to.
Yeah, no, it's interesting you said that, because Michael and I were on our doing our radio show on Thursday. And that was the one thing we said. We said this year, the word of the year will be audible, because it's going to be just, whatever you think is going to happen, we're going to have to call an audible. I may come on here on Friday and say, hey, this is what we think. And next Friday, it'll be totally different. So right. That's just going to be the way it is this year.
Hopefully we don't get whipsawed that badly, but if we do, the value of this is you to be able to tell everybody early, right? So that they can prepare. All right. Well, look, just in closing out the subject, give me just your 30 seconds of, if the Fed lashes itself to the wheel and says, we're going to 7%. What does that world look like?
Well, look, if they lash themselves to the wheel and they go to 7%, look, you're going to have a deep recession. I mean, it's just, again, just go back to the premise of what I said before. How does the economy work? It's all 70% of its consumption, which is all driven by low debt. So at some point, rates are going to hit that point to where people go, I can't afford to buy a house. I can't afford to buy a new car. I can't afford to put any more money on my credit card. In fact, I can't get another credit card because the bank won't lend me one because I have too much debt. So, at some point, somewhere between where they are now, and again, as I said earlier, a lot of these rate hikes aren't even in the system. We may already be past that point where the economy just literally locks up and says, ain't nothing else going to happen right now.
I would say the majority of people I interview think we are.
I think so too. I think we've passed that point. We just don't know yet.
Yeah. So, I mean, there are a lot of people that say the economy just breaks at 5%. I want to say even you or somebody I've heard that come out of your mouth before. At 7%, I just feel like we're kind of in like Raiders of the Lost Ark, the last scene, faces melting.
I like I said, I think Bullard is talking a great game. I don't see how is it possible here? Let's go back to possibilities and probability. Is it possible the Fed could hike to 7%? Sure, it's possible. I just don't think it's very probable.
Right.
Honestly, I don't even think 5 is probable.
Right. And I guess in theory, at their next meeting, they could hike rates by, 300 basis points, right? And just freak everybody out. But they couldn't, highly unlikely they could hold it there for any period of time because of all this meltdown risk that we're talking about. Yeah, so,
I think, and real quick before you jump off that, I think that's the other misnomer of the Fed, that Jerome Powell thinks he's going to get to 4.5% or 5%. He's going to hold it there for 8 months. There's, you can go back in history and look, there's, when the Fed stops hiking rates, it's not long before they start cutting rates. And by the way, rate hikes are a staircase up, rate cuts are an elevator down. So there is not going to, when the Fed start, there's a lot of expectations, market forecasts are like in June or July, the Fed's going to start cutting rates, and they're going to cut my baby 0.75 of a point by next year. End of next year. No. When they start cutting rates, it's going to go from 5 to 0, and it's going to be over a matter of about 6 months.
It'll be a panic, just like, okay, we got to throw stuff out of this balloon. No, not enough. Throw more. Yeah, exactly. All right. Well, look, you titled your piece "The 7% Solution," which you may or may not know, but it's actually the name of a Sherlock Holmes story that Arthur Conan Doyle wrote, and it's really about sort of the later career of Sherlock Holmes. And at that point, Sherlock Holmes is, I think he's a cocaine addict, morphine, cocaine, one of those opiates. And That's what he sort of uses to keep himself through the boredom between cases, right? And anyways, Sherlock Holmes would always talk about his 7% solution that would kind of keep him going through the day. So we may very well need our own 7% solution of morphine if Bullard's right and we get up to that.
Exactly.
All right, so I want to go to another percentage just for a quick second. So I had a really interesting interview just the other day with Steen Jacobson, who's the chief investment officer of Saxo Bank. Looks like the lights are beginning to come back on here again. Steen, he's not as pessimistic as many of us are. He does think it's going to be a volatile, rocky year. But one of the really positive parts of his outlook that really did kind of resonate with me is he said, look, yes, we cost of capital got way too low. And that results in all sorts of malinvestment. Stuff never should get funded. That does. You get asset price bubbles. We sure got them. But he said right now, that's all being unwound, right? The cost of capital now is like 6% for companies. And there's just a lot less that you can afford to do then. So you got to be real focused on what you are going to do with that capital, right? And you jettison the deadwood malinvestment. Prices come down, obviously, that from their bubble price highs, but productivity begins to go up. He says, we're basically going to see a productivity boom coming out of this, right? Just like, almost like a boxer who trains by, trains underwater or by placing weights on their arms or whatnot, right? Like we're going to grind through the purging of all the malinvestment and the bad stuff. And we're going to get used to operating in a world of much higher constraints with higher input costs, higher wage costs, higher cost of capital. But then as we really learn how to succeed well in that, become more productive as conditions begin to ease a bit, like we're going to emerge from this as like a fit brawler. I kind of made the analogy of Rocky IV, where he had to go into the Russian hinterlands and like pull trees on a sled and do, inverted sit-ups from the rafters of the barn, right? So he comes out just this lean, mean fighting machine. And I kind of liked that outlook. I'm just curious, what do you think?
No, look, this is, two things have happened. And when we go back to 2020 as an example. So the one thing that nobody ever thought about, and one of the reasons why stocks did so well in 2020, 2021 is that we shut down the economy and everybody immediately says, well, that's terrible. Economically, that's horrible for the stock market. But what we didn't catch on and what a lot of investors missed was that all of a sudden companies got super lean and mean, right? And they got lean and mean because they shed all their employees and then everybody started working from home, which means I didn't have to have as much office space. But profit margins just boom. Now we've got record profit margins going into this year. Now there's no way we can sustain profit margins where they are, particularly as you're bringing people back onto work and demand is going to fall, profit margins are going to have to come down. But we had this massive boom in earnings power because companies shed all this overhead because of the economic shutdown. So to your point, coming out of this, now we've also got to factor in, now companies are getting used to paying higher cost of capital. They're having to pay higher wages. And so how do I solve that problem? Right? I automate more. We just saw it. I think you and I talked about it just recently, the McDonald's in California. California, in their infinite wisdom, went to $22 an hour minimum wage. And McDonald's says, sounds great. The average net income for McDonald's franchisee owner is like $300,000 a year at $22 an hour. He loses $600,000 a year, some number like this. How do you solve that problem? You automate the whole thing, get rid of all the employees, right? So now he's profitable again. So this is what will happen in the environment is that we've gone from super lean and mean, where companies were having very large profit margins. Now those profit margins are under attack. And what do you think corporations are going to do when they see those profit margins shrink? They're going to try to figure out a way to keep them, right? And so you're going to see more automation. You're going to see a lot more movement towards, lean, reduced staff, more product, and to his point, higher levels of productivity. So more use of technology to increase productivity rates. So I can at least try to sustain those profit margins rather than giving them up entirely. So yeah, I agree with you.
Okay. Yeah. Okay. So you took my sort of positive reaction to his thing, and now you've depressed me again because of the concerns you and I've talked about in the past of the poor prospects for labor as we continue to both offshore but really automate jobs. And look, we've talked about this forever, so I don't want to get deep into the weeds of it, but it goes back to the concept. It's called technical displacement, which is if you displace the workforce at a faster rate, by new technologies, then you are redirecting it to productive use. You create a social problem that's actually greater than the cost savings that you're achieving, right? Yeah. And sadly, I just sort of see us on a collision course with that, but that's a rant for another day.
Yeah, absolutely.
Okay, so look here. Let me just talk about real estate before we get to your trades for the week, Lance, and then we've got a quick little rant and one or two other
things. Let's do it backwards. We had no trades this week because we're already underweight stocks and overweight cash and short duration fixed income, and we're just kind of waiting to see what this market was going to do in the first. What happens in the last week of the year and the first week of January? There's nobody around. Everybody's still just getting back from vacation and trying to figure stuff out. So you get these real volatile markets that just kind of go all over the case. Next week will be the first real week of trading to where we can actually kind of get a grip on what kind of markets are thinking. So right now we're just sitting still, letting the markets do what they want to do. And then next week we'll start, getting some more serious look at, kind of where the market trends are going to be heading over the next month or so.
Okay, so the excess cash that you built up by just gardening, your positioning, as well as doing some tax loss harvesting, not deploying that yet. You're kind of in the wait and see mode.
Yeah, Mike was mad at me on over the holidays because he goes, Lance, you have not posted a trade update since November the 28th, and I was like, it's because we haven't done a trade since November the 28th. That was our last trade, so we've not made any trades in our portfolio for over a month.
Well, this is just, Murphy's Law. So it's been a very busy end of the year. I don't even know if we have talked about this yet, Lance. We're going to talk about it in just a moment relative to my closing theme. But on Christmas, my mother's, she lives in like a senior residential facility. She had a pipe burst in the New England cold. And so everything she owned is basically on its way to the dump. Yeah. So I had to deal with all of that. So I only literally had time just to go press sell on all the stocks that I wanted to get tax loss harvesting done, and most of them were in the precious metals mining space. And I did plan to buy kind of like a near fit ETF, but I just didn't have the time to really do the research and whatnot, and thought, well, I'll just do it first week. And of course, literally first like 48, the 2 trading days, it's up by like 10%, right? So I'm still sitting in cash, and I'm going to see, hopefully maybe things equilibrate a little bit, but.
Yeah, the gold. I was doing a podcast, just before I got on with you, and they asked me, what was going on with gold, and gold was a terrible hedge last year for inflation, right? 7% inflation, gold didn't do a whole lot. It's had a nice little run here lately, and
sorry to interrupt you. It was a terrible hedge, except it was better than all the others.
Well, in terms of purchasing power relative to inflation, it didn't work like it was supposed to. Bitcoin didn't either, by the way. But interestingly enough, there's an interesting divergence going on right now. So gold should track real yields, which is yields minus interest rate, inflation. And so there's a divergence going on. Gold's been running up, and real yields are what you would invert to make it align with gold. There's a divergence that's now happening between gold. So if you now or gold miners, I would definitely take some profits here because you're going to get a pullback at some point. And what'll happen is if we start getting a real bullish market over the next, like today on Friday is a good example, tech stocks just took off again, right? So every time we have a rally in the market, tech leads the way, even though everybody hates it. So you'll probably get a pullback. You get some rotation out of gold into some more of the speculative areas of the market. If the market rallies, you'll get a bit of a pullback because either gold's going to realign itself with real yields, or gold is telling you the Fed is about to break something and inflation's about to fall like a rock. So if that's the case, then gold's going to go higher and real yields will track along with it. But, probably right now, because gold's getting fairly overbought, take some profit. Now, look, let me be clear about something. When I say take profits, that does not mean sell everything, right? That means if you have a 5% weight of gold in your portfolio and it's now 6%, you sell it back down to 5.
Bring it back down to 5.
Harvest the bounty, right? I don't know why people always assume, Lance said take profits. I sold it all and went short. No, that's not what I'm saying. Just trim it back a little bit, prune the tree. But again, it's a little bit ahead of itself. So I think and with gold miners as well, I think a lot of this, again, because there's nobody around, you're getting a lot of these positioning trades that are going on, and it's moving prices, particularly in more thinly traded areas like gold and gold miners. They're getting these big moves that I think they're going to kind of settle back down a bit, and you'll get a better entry point.
Okay, got it. So we talked a lot in the last couple of episodes of, end of year steps that people should consider taking, like tax loss harvesting or required distributions, or, that type of stuff. Is there anything that people steps they should be taking at the beginning of the trading year?
Yeah. Well, so, for the beginning of the year, whatever you buy now, right, you've got till next year to turn it into a long-term capital gain, right? So whatever you're going to do now between now and the end of the year is all short-term. So, over the course of the next, few months, this is where you're going to really start kind of thinking about, what's my thesis? Where do I want to begin to overweight, underweight my portfolio for the next year? Because that's also why money flows come in big at the beginning of the year. So the month of January has bigger inflows than all other 11 months combined. And that's because everybody's putting money to work for the rest of the year, because I did my tax loss harvesting. I'm going to pay my taxes based on last year. So now I've got 12 months to run before I got to worry about paying taxes again.
All right. And as a result of that, do the markets tend to perform better on average in January than most other months? Because
January is the best performing month of the year on average.
Okay. Well, there you go.
Only July and August being shortly behind it in December.
Okay. I think
I'm sorry. I said July. I meant April and July and December are the other 3 months that are the best performing.
Okay.
Yeah.
I mentioned this yesterday with the New Harbor guys, and I'm curious to get your take, but I assume it's the same, which is if you're coming into this year as one of the many people who's creating a New Year's resolution to say, hey, I want to be more financially fit this coming year. I want to take charge of my finances. I want to make sure I get my portfolio in a good place, all that type of stuff. Obviously, the best time to create that plan is last year, but if you didn't, the best time this year is right now. And I kind of remind people that old axiom, to fail to plan is to plan to fail, right? So I would presume you would say, yeah, if you're starting the year with aspirations to be more buttoned up with your investing, situation, this is the best time to call and talk to a financial advisor, or at least identify a financial advisor that you can, help you create that plan.
Right. Absolutely. But let me clarify something, because I'm getting a lot of emails right now from individuals, and they're going, okay, I'm ready to get my financial situation put together. So what do I got to invest in so I can retire in 5 years? Right. And how much money do you have right now? Oh, I've got nothing. Right. Look, there's some basic steps that you need to really, if you're looking at your financial situation.
Step number one is rob a bank, right?
Yeah, rob a bank, and then flee the country. Non-extradition is very important. But no, look, there's some basic. Look, building wealth is not about investing, right? And so here's a financial advisor telling you, don't worry about investing. That's not even important. The most important part about building wealth is learning how to save money, right? You can save money and become wealthy just by saving money. If you can just get your budget at your household in order so that you actually have free cash flow. Now, how can I compound those savings and make even more money? Well, that's where the investing part comes in, but you can't invest until you got the cash flow situation at home saved up so that you've got regular savings coming in that you can contribute. And this goes back to the gardening thing that we talked about before, right?
And if I can just can I add a muscle here to your analogy, which is, I think it was three, right? There's the earning muscle, right? First, you got to earn it, right? Yeah. And you and I have talked about the need in many cases.
Money's got to come from somewhere.
Exactly. If you're not robbing the bank, you got to earn it. And then two, you got to save it. And then three, you got to invest it. And those are three separate different muscle groups. like most muscles working together, they're incredibly strong, but you have to have each one.
Right. And you can't do the investing part unless you do the first two part first,
Right.
right? Because you got money to invest. And look, the market, and here's the important part about this conversation, which is the market, and I want you to hear me very carefully. No advisor is going to make you rich. No, there is nobody that got rich by investing in the markets. Well, Warren Buffett did. No, he didn't. What Warren Buffett got rich from was investing other people's money into the market and taking money for it. Every hedge fund manager in the world, right? So you take a look at Ray Dalio. He didn't get rich investing in the market. He got rich investing other people's money in the market, right? They built a business, and that business created the wealth for them. So if you really want to build wealth, start a business. That's how, that's the way capitalism works, and that's how you build real wealth. But investing is not meant to make you wealthy. Investing, done correctly, is only meant to take your savings and make sure your savings are growing at the rate of inflation over time, so that your savings have the same purchasing power parity in the future that they have today. And when you're talking about 30 years in the future, that's why investing is so important. But this is why also $1 million in 1980, everybody goes, well, if you had $1 million in 1980, you could retire. Yeah, in 1980, you could, because you get 12% return from treasury bills in 1980 versus 4% today. On $1 million, $40,000 is below the poverty line. So, inflation is important, investing is important, but you gotta have your financial situation buttoned up so that you can actually do that for an extended period of time.
All right. There's actually a couple of things in that exposition you just gave that I'd love to dig into. Maybe earmark
next week. Next week.
No, we only got a little bit left here. All right. And so on that side, let's get into the rant real quick,
Sure.
which is, it's more less of a rant, but it's just more, I want to underscore the importance of planning for the unexpected. In most cases, that takes the form of insurance. But just two quick stories, which folks already kind of gotten this flavor of from this interview already. But I just shared how my mother's the pipe above her unit burst, and she pretty much lost everything. She is in a senior living facility, and sadly she did not have the insurance coverage that she thought she did. Would have made things a lot easier and a lot less costly. So just one story there. Second, we're going through this atmospheric river right now at Northern California, where I live, and trees are just falling everywhere. In fact, a tree just fell on my neighbor's property, taking out their well. Right. So right now, you're basically the only conversation you're hearing in town right now is who's got the insurance to cover the damage that's happening on their properties right now. So to me, these are just sort of real world examples to say, hey, de facto surprise you, right? We never expect this stuff's going to happen. And the only way to protect yourself against it is to position for it in advance. And in a lot of cases, the cost of the insurance relative to the gain can be really low. And I'll stop in just a second to give you ability to react to this, Lance. But we may have talked about this once or twice, but like umbrella insurance policies are ridiculously cheap for the extended liability coverage they give you. And so, at the beginning of the year, when people they've got their New Year's resolutions in mind, and they're trying to think about, okay, how do I make this year a better year than last year? I really encourage people to not overlook the risk mitigation part of the equation here. It's so critical, especially and maybe this is where we do rant, is that the U.S. it's become a hyper litigious society. And I just hear more and more stories about people that have been wiped out by a lawsuit. In many cases, it might not even have been a lawsuit that was based in, that might have had a lot of merit to it, but it was waged by somebody with deep enough pockets that they were able to kind of, just financially destroy the person that was trying to defend against them because they just couldn't keep up with the legal costs. So yeah, I guess this is my plug that folks, a great start of your exercise would be to do an insurance audit.
Yeah, absolutely. And look, there's a couple of things. One is, and you're right. look, everybody picks on the, Wall Street as being this kind of rigged game, and that all the Wall Street insiders are on this whole rigged game. The legal profession is just as bad. And about 5-6 years ago in Texas, as an example, we had a kind of a ruling against frivolous lawsuits. So, I sue Adam for, wearing a pink tie on Thursday, right? Whatever. And, there's no merit to the case. And the judge at that point had the ability to, basically throw this back on the person filing the frivolous lawsuit. Well, the lawyers go, well, that's not good for our business because, I make money bringing cases.
It reduces volume. Yeah, exactly.
And so they all lobbied up, and they overturned that law. So now you can just file a frivolous lawsuit against somebody. And again, to your point, if I can file a frivolous law, I don't have to have any proof that you wore a pink tie on Thursday, but I've got enough money in the bank. I can just keep doing subpoenas and getting into your emails and everything else. And a lot of the judges, and particularly in Texas, they're very liberal. So they just say, yeah, whatever, just, give the defense, give the prosecution whatever they want. And then, you just have to defend it later. And so finally you just give up and say, let's settle. Right. And so you wind up paying a bunch of money to settle. And so this is why, we have this very litigious environment. Somebody, there was a lawsuit just recently, we talked about the McDonald's lawsuit, where the coffee cup, and there was another one just recently, and it escapes me, but it was like $5 million for something really asinine. And it's, you should have known that was going to be a problem before you did it. But this is why you have disclaimers on hair dryers not to use them in the shower, right? Because somebody did, and somebody filed a lawsuit, so now you got to do this stuff. But this is why insurance is so important, because if a lot of people, and look, I have this same problem with clients, and I'll give you a good example of this. I had a client a few years back, and I was talking to him about filing, getting some life insurance, right? Just term life policy, right? He was a fairly young guy in his 50s, didn't have a lot of money saved up yet, but had no life insurance. I was like, you need to get a life insurance policy just in case something happens to you. Well, he just hem and hawed around, no big deal. And so finally he calls me up and he says, okay, I'm ready to get insurance. I go, okay, well, I'll get your medical, lined up. And he's like, well, I just got diagnosed with cancer and it's too late. Now you can't do anything about it. And so, this is why, what insurance is, it's an insurance policy against a risk becoming a reality. And so, yes, you're spending money, and I know it feels stupid to buy something that you don't think you're ever going to need. That's not the point of it. The point is, I hope you never need it. I hope you waste money on insurance for the rest of your life, and you live to be 900 years old like Moses, and paid for it the whole time. But just in case, that's why you have it. But this is also why if you're in any type, so, we talk about annuities, and annuities have a really bad reputation because advisors sell annuities. They're high cost products. They're illiquid. But that's the reason advisors sell them. But you shouldn't poo-poo them just because they're a high cost product that are illiquid. If you're in a litigious business where you're a business owner and have the potential risk of being sued, if you're in some type of profession that has a high casualty rate, those are the type of things that an annuity works really well for because they're judgment proof. Ken Lay with Enron died of a heart attack right in the middle of the whole investigation into Enron, had all of his money in annuities. So when that whole investigation into Enron went down, all his assets were protected for his family. So, this is part of the financial planning process. But yeah, you're right. Look, umbrella policies are cheap. Life insurance is cheap. Annuities are cheap. They're a great way to shield assets.
Great. So I'm blanking on the name of the guys, but the great personal finance guys on your team that came on and did the retirement planning seminar, Danny
Ratliff and Richard Russo.
Okay, great. Danny and Richard. I'm presuming that this is a topic that they can opine on all day long for courses.
Yeah. It's part of it's part of the financial planning process that we do for all of our clients anyway. So
great. So interested folks can reach out to them. I'm just thinking maybe what we do is we do an insurance webinar, free webinar on insurance, just like we did for retirement planning. You're nodding here as I'm saying this. So folks, if you're interested in Lance and I exploring that with Danny and Richard, let us know in the comment section below. And if there's enough demand for it, we'll make it happen. All right, Lance. So just wrapping up here, a couple quick reminders for folks. One, we've talked a bit about on this channel in 2-ish months ago or so about the videos that I was putting out on I-bonds because there was such a historically aberrant high rate that you could lock in. I also educated folks about the ability to use the gift box inside the U.S. Treasury's gift box to actually kind of multiply your ability to take advantage of those super high rates. And so I just want to flag for folks, we're now in a new year. We're just at the start of 2023. So if you followed that strategy, and if you gifted any I-bonds to people in your family or had them gifted to you, you can now take delivery of them for 2023. And if you did it through the Treasury Direct .gov website, super easy. I just did it myself the other day. You literally just go in and there'll be a little tab there for gift box, and you just basically click, I want to have receipt taken of the I-bonds that have been gifted. Really easy, but don't forget to do that if you're following that strategy. Secondly, just want to remind folks about what I said at the beginning of the video here about the new Instagram channel. So if you are on Instagram, which I know not everybody on this channel uses, but maybe the younger amongst you or the more social media facile, go over to at Wealthion Official over on Instagram and start following us there. And then last two, I just want to remind folks, I get a lot of folks reaching out to me via the comments on YouTube or even directly from email between these videos asking questions. I try to answer as many as I can. A lot of the questions I get asked are questions that I'm answering or providing additional context about on my Twitter feed. So if you use Twitter and don't already follow me, but would like to get sort of access to, a lot of that commentary and data sharing that happens in between these videos, just go to Twitter and follow me at Menlo Bear. That's my handle there. All right. Well, then in wrapping up here, folks, Lance, we're going to, I think, land the plane by your deadline today, which is going to be great. Might even be a first. But Lance and I talked about how weird a year is likely coming up here. Weird enough that my lighting still continues to keep changing on me here. So highly recommend that you work with a professional financial advisor that understands all the issues that we've been talking about here and is available to you to be making these audible calls and decisions that Lance and I are talking are highly likely to come up here, and making sure that you are being nimble as appropriate for how the reality on the ground is unfolding. If you've got a great one, absolutely stick with them. If you're a DIY guy, likes to do it yourself, hey, not telling you to switch on that as well. But if you like to talk to a financial professional that does keep all this in mind, even just to get a second opinion, highly recommend you talk to one of those that Wealthion endorses. These consultations are totally free. There's no commitment to work with these guys. Lance and his team there and the guys at New Harbor, they just do it as a public service, trying to help make sure as many people as possible are entering the new year as financially prepared as possible. So to set up one of those consultations, just go to wealthion.com, fill out the short form there, only takes a couple of seconds. And if you are enjoying these weekly market recaps and are as delighted as Lance and I are that they are going to continue in 2023 after our experiment in 2022, please do us a favor, support this channel by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. Lance, any parting words here?
Yeah, everybody needs to watch this so it has more views than Michael's did last week. So.
I knew I was going to tap into your competitive spirit there. All right, everybody. Thanks so much for doing that. Lance, another great week. Thanks so much, everybody. Thank you so much for watching.